So good afternoon everyone. My name is Maurya Hanspal and in this session we're going to talk about further on mutual funds and we're going to talk about the fund of funds today. What exactly is a fund of fund? So I'll just explain you. So fund of fund is again a type of a mutual fund only. But the thing is one mutual fund is investing into the other mutual fund. Okay, like for example, you are the person here and you like put in your money and give your money to a mutual fund and that is your AMC one. So that AMC will again forward your money to the second AMC. Okay, so once you have a money here, this money would be forwarded to the other one, and that AMC would be like putting your money in the market, like putting your money in the market. Okay, so basically, indirectly, you are like giving money to this AMC two and directly to AMC one. But since like two AMCs are involved, AMC is the asset management company is involved here, the expense ratio would also be high. Okay. But now the funds of funds, basically like this kind of thing is being used for the companies which are investing into abroad. कोई Indian AMC है, it gave money to the US की AMC and that in turn invested the money abroad. Okay, so in the case of a fund of funds, the expense ratio can be high, but now they've started to cap the expense ratio max to 1%. And the classic example is Motilal Oswal Nasdaq Index Fund. Motilal Oswal Nasdaq Index Fund. It's a fund of fund. You first invest into like Motilal Oswal. Then Motilal Oswal invest into the outside AMC, which in turn like invest into the Nasdaq market. That is one thing. That is the main concept when we talk about your funds of funds. Okay. So it says a fund of fund is a mutual fund that invest in other mutual funds. As I told you, one AMC is investing your money into the other AMC. It does not hold securities in its portfolio, but other funds that have been chosen to match its investment objective. These funds can either be a debt or equity depending on the objective of the fund of fund. It means it can be either both debt, equity, or it can be a multi-asset one. 95% of the total assets should be invested in the underlying fund. A fund of fund either invests in other mutual funds belonging to the same fund house or belonging to the other fund house. So the mutual funds belonging to the same fund house means that both the funds or like both the mutual funds are part of the same AMC only. That is, for example, you have the HDFC AMC. So you are like putting your money into the HDFC AMC, and HDFC mutual fund is in turn like putting your money into the HDFC International Fund, and that is like within the same AMC. But it can be belonging to the other AMC also. Like for example, you put your money into HDFC, and HDFC like is giving it to some other company, so that is belonging to the other fund houses. Now the fund of funds belonging to various mutual funds houses are called multi-manager fund of funds because the AMCs that manage the funds are different. Because ultimately, if your asset management company is giving the funds to a second asset management company, then you might have some multiple managers here, right? Then it says a fund of fund looks for funds that fit into its investment objective. It specializes in analyzing funds, their performance and strategy, and adds or removes funds based on such analysis. A fund of fund imposes additional cost on the investor as the expenses of the underlying funds are built into their net asset value. Equity funds of funds do not enjoy the tax concessions available to equity funds on dividends and long-term capital gains. We talked about what exactly is the NAV. So basically, the purpose can be different because the different kinds of funds are investing into the different instruments. Some can be your equity instruments, some can be your only debt instruments, some can be only equity instruments, some can be both equity and debt instruments. So that's all like they have mentioned here. After that, you have the multi-asset allocation fund. So in the multi-asset allocation fund, it basically allocating into the multi-asset class. That is, minimum of 10% has to be invested into the minimum 3 asset classes. The first asset class is equity, the second asset class is debt, and the third asset class we call it as gold. But now the gold people have also been now starting to include silver as well. That is one thing you need to look into place. But basically, at least in three securities or three investment classes you have to invest your money. Then you have the arbitrage fund. So what basically happens in the arbitrage fund, you're buying and selling, you're buying in one market and selling in the other market. Like for example, if you feel that the price of the stock is much cheaper in on the national stock exchange, and if it's being trading higher at your BSC, so you can buy it at a cheaper price on NSC and sell it buy at a cheaper price on on the national stock exchange, like where the price is too low, and sell it at the Bombay Stock Exchange where the price is very high. Okay, because ultimately you can make an arbitrage profit between the two. But it tends to be like very difficult, because in real life now the difference are not by so much. It might be just by small decibels and all these things. Okay. And they've talked about investing in direct equity versus investing in just equity funds. So what is the difference between like investing into direct equity and investing into just equity funds? So in case of direct equity, you are individually picking up the stocks in the stock market. And in case of equity funds, you are investing into an equity mutual fund. So why the direct equity is beneficial? Like when you have knowledge about the stock market and you have like considerable time as well. The people can devote in the market, pick the stocks, analyze the companies. But not everyone has that considerable time in the stock market. Even if people have knowledge about the stock market, they do not have time to go for it, and they have some other jobs and all. For that purpose, the people can go for the equity funds or the equity mutual fund. Also, in the case where people have no knowledge about the stock market and they want to earn a decent return, a significant return, they can go for the mutual fund, because there you have the portfolio manager, and ultimately the portfolio manager would be helping you out. Okay. And passive and active fund we talked about. We also talked about the diversified equity funds. So what do we mean by diversified equity funds? So what basically is happening in the diversified equity funds? Your money is being invested into the different sectors of equity, right? You might be investing into the pharma sector, into real estate sector, metal sector, IT sector, hospitality sector, infrastructure sector, public sector banks, private sector banks. So basically all this is going on. Then it can be based on the market capitalization also, on the basis of the large cap companies, mid cap companies, small cap companies. That is, companies investing into those, like which are the large cap one. The large cap companies are those which have a market capitalization of more than 20,000 crores. And what do I mean by market capitalization? By market capitalization, I mean the price into the number of shares available in the market. And by the number of shares, I mean the free floating shares available in the market, which are not held by the promoters or locked in by the promoters. So a large cap company is a company that has a market capitalization of more than 20,000 crores. A mid cap company is a company that has a market capitalization of between 5,000 crores and 20,000 crores. And a small cap company is something that has a market capitalization of less than 5,000 crores. And top 100 companies are the large cap companies. From 101 to 250, you have the mid cap companies. And from 251 onwards and above, you have the small cap companies. And the SRF Chemical is the largest small cap company. And now it has shifted to Nifty. It recently, like on yesterday only, it shifted to Nifty Next 50. Okay. Then there can be funds based on sector performances. Like for example, if you want to invest in one particular sector, be it the banking sector, because the interest rates can rise in future and the banking sector can benefit. Be it the IT sector, be it the pharma sector. The pharma sector, they really benefited in terms of COVID. Right? Even the IT sector also benefited. But I believe that if you are like diversifying your portfolio like within sectors, it's called a concentrated diversification. Because अगर उस sector ने अच्छा perform नहीं करा, then the value of the portfolio can come down. Okay, so that you need to know.